Hello everyone, those who are watching this video. My name is Khushboo Reshamwala from class TYBBA section, roll number 286, subject Business Environment. My topic is about the Monetary Policy and Fiscal Policy 2020. Monetary policy and fiscal policy are the two components of the economic policy. Economic policy means the policy made by the government. Policy have an effect on the economic growth of the country. Monetary policy is related to the money supply and is controlled by the RBI. Fiscal policy is the policy made by the government regarding the finance of the country. Starting with the monetary policy. Monetary policy deals with the money supply in the economy. Monetary policy has two types of policy under it. First is the expansionary policy and second is the contradictory policy. First, if the money supply is too fast, then it is the expansionary policy. Expansionary policy, this means that lot of money is injected into the system at a very fast rate, and this is done to give the little push to the economy in the times of the crisis. Such expansionary policy can be benefit at times. We have seen the liquid injection by the RBI to save the economy from the corona outbreak. That was the example of the expansionary policy. Now, the opposite of the expansionary policy is the contradictory policy, also known as the tight money supply or the reduced money supply in the market. By taking an excess liquid, this is done by controlling inflation. So, throughout the contradictory policy, inflation can be reduced. This money supply is treated by RBI time to time to manage to balance the growth and the inflation. But one obvious question arises: how RBI takes away and injects the liquid in this system? Well, RBI has a tool under its monetary policy through which it manages its liquidity in the system. So let's see the tools of the monetary policy. The first tool is the cash reserve ratio. Cash reserve ratio means the percentage of cash that the bank need to maintain with the central bank, which in India is RBI. Basically, in India, we have a system called the fraction reserve banking system, which means whenever the deposit the bank gets, the percentage of that deposit need to be kept with the RBI in the form of the cash reserve. On the basis of the cash reserve rate, the loans are given by or regulated by the banks. Higher the CRR, lower is the liquidity in the market, and lower the CRR, higher is the liquidity in the market. The second tool is the saturatory liquidity ratio. SLR means the amount that bank need to maintain in the form of cash or in the form of gold or in the form of government security. SLR affects the liquidity in the way in which the CRR affects, means cash reserve ratio affects. Means higher the SLR, lower is the liquidity, lower is the SLR, higher is the liquidity in the market. And the objective of the SLR is to manage the liquidity, ensures the stability in the banks, and create demand for the government securities. The third is the open market operation. Open market operation means buying and selling of the government securities. This is done by the RBI to see the condition of the liquidity in the market. Buying securities means the RBI give money to buy these securities which increase liquidity in the market, and selling securities means RBI take the money by selling the security which decrease the liquidity in the market. The fourth tool is the repo rate and the reverse repo rate. It is a rate at which the RBI will give loan to the bank for the short period of time by purchasing the government securities. Repo means RBI give money to the bank, and reverse repo means the bank gives money to the RBI. The fifth tool is the bank rate. The bank rate is a rate at which the bank can get loan from the RBI for the long period. It is similar to somewhat bill discounting and also called the discount rate. The sixth tool is the market stabilization scheme. At the time of demonetization, when everybody went to their banks to deposit all the cash they had, this situation got the sudden flooded in liquidity with the bank, and the bank were in the no situation to use this excess liquidity, but they had to pay the interest to their customers for their deposit. So to stabilize this situation, market stability scheme were used, where all the cash were absorbed by the central bank and interest were paid on the deposit by the RBI to the banks. This scheme was used to reduce the sudden liquidity shock in the market. And the second economic policy is the fiscal policy, a policy in which use of government spending and the revenue collection to influence the economy. There are three main components of the fiscal policy. The first is the taxation, second the borrowing, and the third the expenditure. The objective of the fiscal policy is to increase the aggregate demand in the economy. Second, the managed resource allocation, manage distribution of income, and promote development of the country. To achieve the objective, government announced many measures in the fiscal policy, but while doing so, almost every year the government expenditure greater than the government income. So this is the discussion about the monetary policy and the fiscal policy. Thank you for watching this video.